If you believe that all stockbrokers, for example, are both competent and honest, read what one stockbroker had to say about his training to become a stockbroker. My background. Hello, I'm V. Full Headquarters recently asked me to share my 3-year experience as a stockbroker with a large national firm. My background, to begin, includes a BS degree in business along with an MBA degree. After my graduate degree in business, I set out to land a job as a stockbroker, having always been intrigued with investing. I loved the subject of finance, was excited about becoming a professional investor, and was thrilled when I landed a job as a broker in a mid-sized city at one of the largest national investment firms. I worked there for 3 years prior to moving on to a local bank to start an investment subsidiary. I'll share a few of my findings after my 3-year stay at the firm. To be honest, the job hunt for that brokering position was actually quite difficult, as it became increasingly clear to me that my educational background and training were far less important than the fact that I had no prior sales experience. One brokerage firm even suggested that I sell copiers for 2 years and then reapply. Eventually, though, my persistence paid off, and I got a job with one of the majors. The training began with a 3-day crash course to prepare for the Series 7 exam, which tests prospective brokers on the basics of investing, that is, common, preferred, and convertible stocks, bonds, and options, along with the rules and regulations of the Securities and Exchange Commission. I sat for the exam with 3 days' worth of knowledge packed into my head. 2 weeks later, the results came. I had passed. The intensive 3 days of study had paid off, and I was now ready to share my newfound knowledge, helping others with their financial futures. I was a stockbroker, registered representative, financial consultant. The title kept changing. Next up was the appropriately named, no joke, Guerrilla Cold Calling Course, so named because we were told by our manager that even a guerrilla could be successful if he just made enough telephone calls. I guess my college and graduate business degrees really were not important. The cold calling course involved learning how to dial up as many people in an allotted time frame as possible. It didn't matter whether you were selling stocks, bonds, timeshares, or aluminum siding. The key was to reach out and touch prospects. My manager shared with me the rule of thumb on cold calling. Out of 100 actual telephone conversations per day, 10% would listen to my pitch. Of these 10 gullible souls, 20% or 2 should be a sell. That adds up to 2 new clients out of only 100 calls. So I was told that I simply had to telephone 500 people per week, just 2,000 per month, only 24,000 per year, and I'd be on my way to success as a broker. Now it was time to put my comprehensive training to use and begin helping out those Americans less knowledgeable about their money. I started with the Stockbroker's Guide to Success, the Yellow Pages. My list of doctors, lawyers, and any other prospective candidates was ready each morning for the office manager to inspect. I then spent most of the day smiling and dialing, and dialing, and dialing, and dialing. Now, most successful professionals get called by a lot of salespeople, and as you might guess, few are really receptive to the calls. The 2 out of 100 rule is pretty accurate. But from the industry side of the table, the prospecting for transaction profits was well worth it. You just have to love the investment focus at these firms, don't you? Each day at 3 p.m. the closing bell rang, at which point the manager cruised by to review the commissions generated that day. Sell, sell, sell. That is, whether you're buying or selling. In between all this mindless prospecting, there were other activities, such as the morning squawk box call, when upgrades and downgrades were announced from New York over a scratchy 4-inch speaker. These new recommendations generated buying and selling opportunities for the brokers. To win as a broker, you were there every morning for the squawk box call. It meant commissions. And each week, the firm held a company-wide technical analysis conference call with a chart guru at the home office, supplying important support and resistance levels for those interested in short-term trading and options. One of the more popular option strategies was the Cadillac Spread, which involved selling a call option on a stock while simultaneously buying a put option. This generated 2 commissions and then 2 more when the positions were subsequently closed. The term Cadillac Spread was coined because it helped make the broker's car payment by generating a total of 4 commissions on a single stock. Finally, each week a sales meeting was held to tout the current focused investment. There was one of these pretty much every 2 months, with concentrations on oil and gas, real estate, and new movie limited partnerships, as well as the announcement of new mutual funds with a twist, and variable life and annuities. Packaged investments were great vehicles for brokers because they typically had high and somewhat obscure commissions built into them, and many of the limited partnerships were structured as tax shelters, making them easy to sell. I recall one prominent CPA at the firm that almost always recommended against such investments on the basis that the client immediately lost 15 to 20% on the fees and commissions. This CPA was labeled a troublemaker at the firm, and any outside investor that asked to review an investment with him was written off as a lost sale. But I particularly disliked the Tuesday work nights when we were given the list of stocks that the firm had in inventory, which we could offer to our clients commission-free. Our firm, of course, compensated brokers for these trades, actually more than a normal reward, and the client saw no commission appear on the confirmation. Now there's a good reason to buy a stock. You can, of course, bet that if the stock was stuck in our inventory, previously unsellable, then getting it at no commission was hardly a bargain. By now you should have the impression that the typical broker is all about selling and generating commissions, either because of the quotas established by the firm or due to their own drive. Many have no other way to make a 6-figure income. Most have college degrees, but not all. Any sort of financial training for the broker paid on commission really isn't as pertinent to her success as the need to make money, the love of selling. Stockbrokers are, first and foremost, salespeople. The industry is built on this. I and many others view this as a conflict of interest. I believe that how they are compensated runs contrary to their fiduciary obligation to clients in a series of small and very large ways. Bottom line, the only person that can take personal and unbiased interest in your investments and hence your future is you. Even if you work with a professional, you must be vigilant. Ask questions. Get performance reports. It's your nest egg, college savings, and retirement. I personally have learned 10 times more in my 3 years of reading and following the Motley Fool than I ever did in my 3 years as a stockbroker. I still don't know it all, but I learn a little more each day. Good advice. Keep learning. Now you can probably see why I recommend that you should do your own research, make up your own mind what stock you want to buy, then use your broker only to make the transaction. Don't let them manipulate you, in many cases to their advantage, not yours. In most cases, find a broker that has low transaction fees, even if that means they don't provide a lot of services. The best deal is to trade online using your computer. Let's see why this is so. Large brokerages usually have one price for transactions involving a phone call to a broker, another price if you use a touch-tone phone, and the lowest price if you trade with your computer. The best way to choose who your broker is going to be is to do research on the best prices for the type of trading you are going to do. Some brokers charge one price for trades up to a certain volume and rapidly up the price as the volume of shares traded goes up. If you'll be trading small numbers of shares, find a brokerage that has low fees for that number of shares. If you will be trading mostly options, find the broker with the lowest fees for options. Match your brokerage with your type and style of trading. If you can get a flat rate, no matter how many shares you buy or sell, that is the best deal. If you are trading options frequently, look for the best price on options, etc. Example. Let's say you are just starting out and you are a fairly active trader and trade 10 times in 2 weeks. Each trade is under 500 shares. If you had used a phone call to a broker to make those limit trades with Ameritrade, it would have cost you $230. If you had made those same trades over the Internet, it would have cost you only $130, a savings of $100. Keep in mind that this $100 is part of your profit. If you had used Daytech, another broker, it would have cost you only $99.90, an even greater savings. As of this writing, Daytech has been bought out by Ameritrade. If your same 10 trades had been over 500 shares each, you could have saved even more with US RECA, yet another discount broker. So you can see that it really does make a difference, and shopping around for the best broker for your type of trading can be very important, especially if you are going to be an active trader. Price, however, is not everything, which is of course what the more expensive major brokers will tell you. Service and the speed of your transactions are also very important, especially if you are a day trader or someone who is at home during the day and using real-time streaming quotes. Some brokerages don't update their trading data until the end of the day, so at any given time you may not know where your account balance stands. Make sure that you use a brokerage that allows you to use margin trading. Margin trading is when your brokerage loans you from 2 to 3 times the amount of money that you have in your account. For example, if you have $2,000 in your brokerage account, you can purchase up to $4,000 worth of stock. When you sell the stock, you pay back what you have borrowed with some interest, usually from 6 to 10%. First, let's take a look at some of the advantages of margin trading. Increased purchasing power for additional securities. You can borrow against your current holdings to purchase more marginable securities. This is the most common use for margin. For example, you own 100 shares of ABC at $50. Your account is worth $5,000. You can borrow up to 50% of this value to purchase more securities. Therefore, you can use an additional $2,500 to make your purchase. This would make the market value of your account $7,500, and your debit balance would be $2,500, or 50% of your account. For margin accounts, there is no set payment time to cover your loans against your securities as long as your account is in good standing. What we mean by this is that as long as the market value of your securities does not drop to the level where we would require a margin call. This requirement will vary from broker to broker, so be sure to read the fine print. There are also some disadvantages associated with margin borrowing. When you borrow funds from your margin account, you increase the amount of your debit balance. As market conditions fluctuate, and they always do, the value of your marginable securities will also fluctuate, causing a change in your overall account balance and debit ratio. As a result, if the market value of the securities held in your margin account depreciates, you may be required to deposit additional funds or make full payment of your margin loan to bring your account back up to maintenance levels. This, however, will never happen if you use protective stop-loss orders, which we will discuss in just a minute. Margin accounts involve added risk and may not be suitable for all investors. In a cash account, your risk is limited to the amount of money that you invested. In a margin account, your risk includes the amount of money you have invested plus the amount that has been loaned to you. Believe me, the broker and their bank are not going to lose money that they have loaned to you to purchase stocks. Let me make this point very clear. Borrowing on margin is not for everyone. It is a handy tool for the experienced trader and a nightmare for the novice. You must know what you are doing before you try this type of trading. One very good website to go to in order to research brokerages is yahoo.com. Now let's take a look at how the market really works. Let's see if we can answer some of these questions. Let's talk about buy low and sell high. How do we do that? The price of stock has very little to do with the company it represents. Interesting topic. Prices are moved because of the way people think. Is insider trading legal or illegal? Amateurs watch the news and buy based on good or bad news. Buy low and sell high. Isn't that what everyone does? If you think that the market is going to drop and therefore want to sell your stock before that happens, there must be some poor guy out there that thinks the stock is going up and is therefore willing to buy it. The stock market is adversarial in nature and you must be very careful. Remember those sharks we spoke of earlier? Stocks always look worst at the bottom of a bear market when an air of gloom prevails, and best at the top of a bull market when everybody is optimistic. Have the strength to buy when things look bleak and sell when they look too good to be true. In other words, do the opposite of what most traders are doing. Remember, most traders are losers, so you don't want to do what they are doing. Most traders jump on the bandwagon very late, just as it is ready to take a dive. Don't be one of them. After a stock has dropped for a while, most traders avoid it until after it has taken a good rise. By getting in earlier at a great price, you can make more money. Be willing to do what most are afraid to do. This concept took me quite a while to completely understand. Since all the mainstream analysts and media experts always touted the importance of the quality of the companies, I assumed that a good company would have the best stocks to buy as well. But Dr. Elder says the price of stock has very little to do with the company it represents. The price of IBM stock has very little to do with IBM. The price of stock is connected by a mile-long rubber band to IBM, and it can be wildly higher and wildly lower. IBM just keeps chugging along, and it's a very, very remote connection. Price is the intersection of supply and demand curves, and these curves are not driven by the quality of the company, but rather the perception of the quality of the stock. Two companies with exactly the same fundamentals will likely have very different movement of their stock prices. Don't fall for the hype about the quality of the company you are looking at. Look at the movement of their stock. Markets and prices are moved because of the way most people think. Their perception is driven more by media hype than reality. Prices on a company's stock go up and down based on the perceptions of the crowd as to the value of the stock. The company could be in a great position in the marketplace. They could have increased their revenue 50% and become more efficient. But if their earnings report comes out and doesn't meet the expectations of the industry analysts by even a few cents, the perception of the crowd could drop the price of the stock drastically. I've seen it over and over again. Two companies with almost the exact same news or earnings reports, and yet their prices move in opposite directions. Dr. Elder says, respect the strength of the crowd, but do not fear it. Crowds are powerful but primitive, their behavior simple and repetitive. Once you understand that the stock charts are merely graphic representations of crowd behavior, you will be well on your way. Individual behavior is unpredictable, but crowd behavior is very predictable. Once you begin to recognize this fact, your trading will take off in a positive direction. Some investors simply can't resist following what is hot. Are you one of them? The irresistible urge to get in on the gravy train and join the rest of the flock can be deadly. By jumping on the bandwagon because of the news and hype of the media, you will always be late and you will fall into the hands of the professionals. Resist this urge. The masses are not well informed. They are moved mainly by their emotions, and history has proven them to be consistently wrong. Their emotions are driven by news and opinions that are either misleading or at best late. In either case, they lose. Resist the temptation to follow an exaggerated trend, no matter how assured it appears. Buy only stocks that have the fundamental value and have positive technical indicators. What do you think? Can companies manipulate us? Companies have several ways of manipulating the price of their stock. Let's say that the upper management of a large corporation are getting ready to announce some great improvement in their widget. They know that this will cause the stock prices to rise a great deal. What do? Go out and buy a bunch of the stock at the current price? Not on your life. First, they release some bad news, either real or sometimes contrived. The price of the stock drops. Then, just before their announcement, they buy as much as they can at the lowest price. After the announcement, of course, the price skyrockets. Is this type of insider trading illegal? Of course, but it goes on every day. As you can see, the market can indeed be a dangerous place. Not only do companies have ways to hoodwink us, but brokerages and their expert analysts manipulate us as well, as evidenced in the following article by Michael Sincere and printed here with permission from Pristine.com. Many traders are already aware of the games some pros play to separate them from their money. As traders, we know that market makers and specialists will play games such as running the stops, artificially gapping stocks up or down at the opening, and acting as the axe on certain stocks. But these games pale in comparison to the games many Wall Street analysts play on unsuspecting retail investors and novice traders. Some of the most notable offenders have been identified in the press, including PaineWebber analyst Walter Pike for his $1,000 a share price target for Qualcomm in 1999. The press has also had a field day with Henry Blodgett, the Merrill Lynch analyst who put outrageously high price targets on Amazon.com when it was trading at $250 a share. Then we have well-known internet bull Mary Meeker from Morgan Stanley, who told people to buy Priceline when the stock was trading at $165 a share in 1999. She repeated her recommendation at $78 and then again on the way down until Priceline fell to less than $3 a share. Can you imagine that? Mary was still telling people to buy Priceline after it hit $3. Why would she do that? So what did Mary tell astute investors when they questioned her about the discrepancy between the poor fundamentals and her recommendations? Forget about traditional stock valuations based on earnings, she said. Morgan Stanley and Meeker both made millions in fees that year. So what was Mary doing? She was paid by Priceline to lie to us. That is the bottom line. In a scathing report on how analysts do business, CBS 60 Minutes interviewed Tom Brown, who is fired from Donaldson, Lufkin, and Generette, now CFSB, who revealed some of the secrets behind analyst recommendations. I don't know, frankly, how some of these analysts live with themselves, he said at the time. They really are cheerleaders, Brown said of analysts. The investment banking group wants you to be wildly bullish about everybody. It is rather obvious that individual stocks are being manipulated by savvy pros who are using 24-hour financial news programs to pump the companies they represent. And it's not just the pros that do this. A few years ago, a 15-year-old boy got caught doing the same things he had seen the pros do. He would buy a stock and then put outlandish opinions on investor blogs and then sell the stock as others bought his lies. They wanted to put this kid in jail for doing the same things that professional analysts do. Does that seem fair to you? Oliver Velez said, for instance, how does an institutional mutual fund that is a client of a major Wall Street brokerage firm get out of 4.4 million shares of an individual stock in a short period of time? To sell 4.4 million shares close to the desired price in a short period of time, you need a buyer. To help support the buy side is a brokerage upgrade, an analyst recommending the stock to retail investors. Although this action is not illegal, I think if more retail market players were aware of this activity, they might be a little more cautious about brokerage upgrades and downgrades. Historically, they have a horrible record. So the next time you see a stock either upgraded or downgraded, you may want to remember this. Try reading between the lines and ask yourself, what is it that the analyst is really trying to do? Amateurs watch the news and buy based on good or bad news. Do you find this hard to believe? Isn't this what you and most of your investing friends do? You get some hot tip or see some great news and decide that some stock is worth buying because of its future potential. Now remember this. The pros watch the technical indicators and wait until they move before they buy and sell. Which group do you want to be most closely associated with? So how do most amateurs behave? Amateurs bail out when everyone else does and buy when everyone else does. Here's a tip. Amateurs do most of their buying and selling in the morning and around lunchtime. The pros and the big smart money make their trades between 1 and 3 p.m. Eastern Standard Time. So if you want to sell a stock, early in the morning during the first hour is best. And if you want to buy a stock, later in the day is usually best. So, have you ever received a hot stock tip? Well, tips are for waiters. My advice, forget stock market tips. Once you learn guerrilla investing techniques, you will have the good judgment to not rely on unreliable information. A tip on the stock market is a recommendation from a stranger who may or may not have the facts. Take the tip and study the company. Only then should you make a decision. Don't buy or sell based on third-party tips. Remember the 15-year-old kid and his hot stock tips. Usually a hot tip is made by someone who has a vested interest in selling you a stock they already own. Is that really in your best interest? Now let's move on to Chapter 3, Market Psychology. Here is some good advice. Knowing where the crowd is headed is your key to success. Knowing yourself is your key to survival. By knowing what the crowd is doing, you can predict the short-term future and buy and sell stocks at a profit. By knowing yourself, you can set up rules and discipline yourself so that you keep the money you make. Both are necessary. One of the phases or steps that traders go through is learning to control their emotions. Learning to control your emotions while trading is a major bridge that all traders must eventually cross if they are to be successful. Dr. Elder's book, Trading for a Living, is great in helping to understand this concept. Due to his background as a practicing psychiatrist, he has incredible insight into this area. Those who ignore this important area are doomed to failure. Being anxious or afraid is one of the first emotional hurdles to overcome. Beginning traders usually fall into this category. Due to a lack of experience, they often make trading decisions based on fear. If you have had some recent losses, you will be fearful of having more. You will often get in a stock too late because you want to make sure that it is going in the direction you have anticipated. Next, you get out too early because you are afraid it may turn down on you. Your emotions drive your decision-making processes. By recognizing this, you have taken the first step towards taking your emotions out of your trading. Another form of fear comes again after several losses. You get the feeling that you need to make up those losses quickly. This is somewhat like losing in Las Vegas. To make up a large loss, you may take an even riskier position in the hopes of making up the loss quickly. This, however, rarely works, and often you just end up losing more. So my advice is, the day after a large loss, it is a good idea not to trade at all. Wait until you have calmed down and accepted your fate and can make a rational plan to slowly and steadily make up what you have lost. Never place yourself in the position where you feel that you have to trade on a given day. If you feel that you must trade, you are very likely to choose a stock that is the best of a group of poor stocks on that day, and the best of a group of poor stocks is still a poor stock. So, in order to stay out of trouble, Please repeat this phrase often each and every day that you trade. If you don't have to trade on a given day, you are more likely to be very choosy. If a stock isn't a really good deal, just don't buy it. Choose only the very best stocks at just the right time. If the time isn't exactly right, you simply wait until it is. By having this attitude as you trade, you will find that you don't trade often, but when you do trade, you will trade well. Having a few very good trades is a lot more fun than having a lot of marginal or poor trades. Another emotional hurdle that many traders experience is greed. There are several ways that you can identify if you are a greedy trader. For example, watching a stock jump way up right after you have sold it can affect your judgment. You may think that if you had just held on a little longer, you would have made a killing. So, the next trade you are in, you decide to hang on a little longer than you did before. Funny thing, after hanging on to your stock, it takes a big drop, and you end up not making as much as if you had sold like your rules of trading dictate. The next hurdle to clear is overconfidence. A few wins can cloud your mind and make you feel invincible. As a beginning trader, if you follow all my rules, you should have winning trades right from the beginning. This may, however, lead you to believe that you are an accomplished trader. You may feel like you have a real skill at this new game. The odds are that you don't, at least not just yet. It takes several months or a year to become a truly wise trader. By thinking that you are an expert, you are more likely to alter or ignore some of your rules and to take greater risks than you should, leading you to losses. The day after a big win, it is a good idea not to trade. Don't be in a hurry to give back some of your winnings. The feelings of thousands of traders merge into huge psychological tides that move the markets. The majority of traders are able to find good trades, but because they are unable to manage their emotions, they manage their accounts poorly and thus lose in the marketplace. All winning professionals know the enormous importance of psychology in trading. All losing amateurs ignore it. You can succeed in trading only if you handle it as a serious intellectual pursuit. Emotional trading is lethal. Winning needs to be paramount in your mind. The amount of money is not as important as the fact that you had no losses. When I trade, I hate to lose on any trades. I want to be a winner on every single trade I make. The amount of money made on the wins is not as important as the fact that I had few, if any, losses in a given month. My goal at the beginning of each month is not to have any losses. The closer I get to achieving this goal, of course, the more money I make, but it is the lack of losses that is the focus. To help ensure success, practice defensive money management. A good trader watches his capital as carefully as a professional scuba diver watches his air supply. As you dive, you may go 100 feet underwater. If your air runs out down there, you will not be able to make it back to the surface before you suffocate. To avoid this terrible situation, you always keep a close eye on your watch and air pressure gauge so that you will know when it is time to surface. It is the same when trading stocks. You must treat every penny lost as important. You must do all that you can to make sure that you don't make the same mistakes, because if you don't, it won't be long until you are out of business. Successful traders treat trading as an intellectual pursuit. The winning is more important than the money. They constantly strive to improve their skills, to win a higher percentage of the time, to lose less often. It is this constantly striving to win and to improve that separates the long-term winners from the losers. Losers in the market have many excuses. You may have even used some of these excuses yourself. If only I had the insider secrets. If only I had started with a larger account. If only I had the magic computer software that automatically finds the best stocks so I don't have to think. If only I had had real-time data, and on and on. The truth is, if you will take the time to study the market, do adequate research before you buy, and apply sensible rules to your trading, you can be successful. This is not rocket science. If you feel that you are trading too much and the results are poor, what should you do? The answer: stop trading. Wait until your emotions are under control. Take the time to look at why you are losing. Evaluate your losing trades and look to see if you are breaking any of the rules of trading. This will give you a chance to re-evaluate your trading. If the urge to trade is so strong that you cannot stay away from the action for a month, then it is time to visit your local chapter of Gamblers Anonymous. In order to be a successful trader, you must know your weaknesses and then do something about them. Once you have discovered your weak areas, you must make changes. One way to help in this endeavor is to keep a diary of all your trades. Write down the reasons for entering and exiting each trade. Get to know yourself. Remember, the market is not forgiving of those who delude themselves as to why they are losing. Chapter 4. Managing Your Money. The single biggest mistake that losing traders make is not knowing themselves and, consequently, not setting up rules of trading that prevent them from being washed out of the market. If you cannot force yourself to make trading decisions based on sound principles, you should not get into the market. If you are the type of person that simply ignores the rules, please just go to Las Vegas or Atlantic City and gamble your money away, or send it to charity, or just write me a check, because it is just a matter of time before all your money will be gone. The first goal of money management is survival. You need to avoid risks that can put you out of business. The second goal is to earn a steady rate of return. And the third goal is to earn high returns, but survival comes first. Most amateurs reverse this priority and immediately try to go for the high returns, thus ensuring their demise. Does this sound like anyone you know? Never risk all of your money on one trade or in one company. If you risk 25% of your money each trade and you lose 4 times in a row, you are out of business. If, however, you risk only 10% of your money on each trade, you can lose 9 times in a row and still be in business. Bert Doman, who is one of the few people I know who actually knows what he is talking about in the stock market, says the following: "The best market traders in the world, who make millions of dollars a year for themselves, state that maybe only 20 to 30% of their trades are profitable. The others are losers. But they make money because they cut losses short. Risk control is the name of the game to investment success." Now let's just see how good your imagination is. Imagine the largest slide you have ever seen, with rusty old rails that are torn and jagged. Now imagine at the bottom of the slide a bunch of broken bottles and cans. Now imagine that among the broken glass there are poisonous snakes. What is the best way to avoid the broken glass and snakes? That's right. Just don't get on the slide to start. But let's say that you have been enticed onto the slide by a friend. You are now headed down and begin to see what might happen. You, like so many before you, might reach for the rails, but the pain will likely be too great, so you let go and take your chances at the bottom. This is a lot like trading. If you get on the slide and begin trading without setting protective stop orders, it is a lot like getting on the dangerous slide with nothing to save you. For short-term traders, it is imperative to use stop-loss orders. They are what keeps you from sliding to your doom at the bottom of the slide. Try to never risk losing more than 2 to 5% of your account balance in any one trade. This means that if you have an account of $5,000, you shouldn't risk more than $100 to $250 on a given trade. Many professionals will tell you that this is insane, risking up to 5% on several trades. However, remember that they lose over 70% of the time. With my safety filters, you should win over 70% of the time. So although you may lose more in a given loss, you have much fewer losing trades and thus end up way ahead. To end up ahead, you must place protective stops so that if the stock price heads the opposite direction of what you had anticipated, an automatic sell will be triggered. This is one of your safety nets while trading. This means that you don't stay with the losing trade. Rather, you get out quickly when things don't go as you had planned and stand aside and find out what went wrong. Before trading, you set a limit as to how much you are willing to lose on the trade, and then, and this is critical, you stick to that limit. Now let's discuss the different types of orders. A market order is an order to be executed at the current market price. Buy market orders accept the current offer, and sell market orders accept the current bid. So when you place a market order, you are simply willing to accept whatever the market is at the time you place your order. The market will determine what you buy or sell your stock for. A limit order is an order that sets the highest price the customer is willing to be paid or the lowest price acceptable. Buy orders may be executed at or below the limit price, but never higher. Sell orders may be executed at or above the limit price, but never lower. A limit order therefore places you in the driver's seat. You control what you will buy or sell your stock for. Now let us look at our protective stop orders. A stop order is a memorandum order that becomes a market order when the price is reached or passed. Buy stops are entered above the current market price. Sell stops are entered below it. In this type of order, you place the order in advance of a specific market condition. The market condition is a trigger. When the trigger is reached, then and only then, an actual order is placed on your behalf. The order that is placed with a standard stop order is a market order that accepts the highest bid or lowest sell order. The transaction is therefore immediate. A stop limit order is similar to a stop order, but it becomes a limit order instead of a market order when the price or trigger is reached or passed. Buy stop limit orders are entered above the current market. Sell stops are extended below it. In this case, the trader has more control. Very often when the price of a stock takes a rapid dip, it often bounces back up, at least for a short time. A savvy trader might set a trigger and then place the price of the limit sell order somewhat higher than the trigger, hoping to lose less money on the trade. This, however, is somewhat riskier and is not for all traders. When you first enter a trade, you set a protective stop-loss order so that you will lose no more than 2 to 5% of your account balance. This can be set at the lowest price of today or the day before you bought the stock. This stop is to protect your assets or principal. As the price of the stock goes up, you then set stops to protect your interest or profit on that trade. As your technical indicators tell you that the price is about to change direction, you tighten your stops or you place a sell order to close out your position. Let's say that you have $5,000 in your brokerage account. Being conservative, you decide that you don't want to ever spend more than 50% of your money in any one trade, so you decide to spend $2,500 on a trade. 5% of your account balance of $5,000 is $250. You find a stock that you like at $10.60 a share. The low of the day you look at the stock is $10.20. You assume the worst case scenario that you have to sell your stock at this price. It becomes your automatic stop loss. The difference between your bid price of $10.60 and the anticipated stop loss of $10.20 is 40 cents. This is your stop loss differential. Now divide $250 by 40 cents, and this is the maximum number of shares you can buy, 625. 625 shares times 1060 equals $6,625, much more than we want to spend. If we had more money and we bought 625 shares at 1060 and then got stopped out at 1020, the worst case scenario, we would lose only $250, which is our maximum allowable loss. We now know the maximum number of shares we can buy and stay within the 5% rule, but we must still stay within our budget. Instead, we buy 235 shares. At the left of this chart, we will assume that day 1 is the first day that we look at the chart. You can see that the closing price of that day, the day we make our decision to trade this stock, is $10.60. The closing price is near the middle of the price range for this day, so we decide to use it for our bidding price tomorrow. On this same day, the lowest price of the day is $10.20. We will use this price as our planning stop-loss order. It will help us determine how many shares we can buy, as we plan on using it as the worst-case scenario of the price we will sell at. To determine your stop-loss differential, you must anticipate your protective stop below where you think the lowest price of the day will be tomorrow, on the day that you will be bidding, or today as you look at the current charts. More experienced traders will try to anticipate tomorrow's low, while beginning traders will be more cautious and use the actual price from today, which is on the charts, which is much easier, obviously, to determine. A stop loss is set based on reality, the actual prices you see on the stock charts. In this case, you would have to buy less stock, 235 shares, instead of the 635 shares that we thought we could afford originally. On day 2, the day we actually plan on trading, we see the low price of the day is $10.48, which is below our bid price of $10.60, so our order is filled at $10.60. The high price of the day was $11.07, and the closing price of the day was $10.76. So at this point, we have made 16 cents profit on our trade. Now the first order of business is to protect ourselves, so we immediately place a stop-loss order at the lowest price of the day, which is $10.48. As you can see, the stochastic is headed up, so we anticipate that the lowest price of each succeeding day will be higher than the previous day. Here again is our formula for setting stop-loss orders. First, we determine our account balance and then multiply that by 5% to determine our maximum allowable loss, which in this case is $250. Step 3. Determine the lowest price of today, or in some cases yesterday, minus 10 cents or more if we have a very volatile stock. If a stock is headed up, the lowest price for tomorrow should not be any lower than the lowest price of today, minus 10 cents as a caution for volatility if we so choose. In this case, it is $46.50. Step 4. Figure the difference between your anticipated buy price and the lowest price of the day. Step 5. Divide your maximum allowable loss by your stop-loss differential. So it ends up that to be safe under these current conditions, we should not purchase more than 71 shares of this particular stock. Step 6. Multiply the number of shares above, 71, by the price you are bidding for the stock, $50, to determine if you want to spend this much money on this trade. In this case, $3,550. So what do you think? It is more than half of the account balance, and we may want to spend only $2,500 on this trade. So we divide $2,500 by the bid price of $50 and decide to buy only 50 shares. If you have only a small amount of money in your account, you may want to risk losing a higher percentage of your account in each trade or buy fewer shares. Which do you think is better and safer? That's correct. Never risk more. Simply buy fewer shares. This chart will give you an idea of what it is like to trade and to use stop-loss orders. On day 1, as the stochastic bottoms out and the volume jumps up, we see it is a good time to buy this stock, assuming that the weekly MACD is of course headed up. You will learn more about these technical indicators in the next class. Because the closing price on day 1 is very high on the price bar, we anticipate that tomorrow's low price will not go down much, if at all, so we decide to bid at the close of the day. On day 2, it appears we had a little luck and our bid was taken and our order filled. After seeing that our order was filled, the first thing we do is place a stop-loss order. We set it at the low price of the day, which was very near our purchase price. At the end of each day, we continue this process of removing one stop order and replacing it with another at the low of each day. Stop orders cost nothing. They are free, so be sure to use them, especially as a short-term trader. On day 7, we see the stochastic has risen to 80, and our MACD is above the center line, so we begin to prepare to close out our position. We can do this in several ways. First, we can keep replacing our stop orders until we get stopped out. Second, we can tighten our stops. Instead of placing our stop at the lowest price of the day, we can instead choose a slightly higher price for a stop so that we sell at a higher price. Third, we can simply remove our stop-loss order and replace it with a sell order at an even higher price. The only problem with this is that if the highest price of the day is not as high as our sell order, we could be in trouble, or if the stock takes a sudden downturn, we would be left unprotected. By choosing the right stock and properly understanding our technical indicators, this will not happen very often. If it does, we simply place a market order to close out our position the next day. In this example, that would cause us, in the worst case, to lose some of our profit, but none of our principal. And remember the definition of a good trade. It is a trade where we didn't lose any money. So in this case, no matter how we closed out our trade, it was a good trade because we didn't lose any money from our principal.